Hi there. So it has been volatile times in the market. Now, and the obvious question is the worst over. Now, that is very difficult to say, and what is very critical to understand is that if this was the worst, then should we invest now? And there were many questions, and many people actually bailed out of their SIP also during this period. Now, what we have tried doing over here is just to understand on what does the data tell us from our 25-26 year period perspective, that when will the markets stabilize, when will it go up, and what should a retail investor do. So what we did over here was very simple. We brought in all the 25-26 years of data and then tried analyzing using the basics of Google Sheet and figuring out what does a SIP of 25,000 rupees give us over a period of 25-26 years, and what does a SIP, what does the data tell us otherwise, like what are the best times, what are the worst times, what should a retail investor avoid. And not only this, what we also tried layering on top of this is the GDP data, because many a times things are oversimplified that the markets are trading below the PE, and if it is trading below the PE, then just invest because finally it will adjust and the PE will go up and you will be able to make more money. But the key point is that if the GDP is expected to shrink, which especially in case the war lasts for longer, then it is expected to shrink across the globe and especially in an Indian context too, then what is the impact? You should be at least aware of that. Now, so what we did, as I mentioned, we brought in all the data. We looked at some really highs and lows of the markets. And the first thing that we started with was a very basic calculation right here on the Google Sheet, trying to understand that, if you had 25,000 rupees every month starting from the beginning of 2000, or for that matter, 2001, and you came up with a very simple logic that, if I have this 25,000 rupees and if the markets are trading below a average, then I will invest 35,000 rupees into equities, because what the intent over here is that on a regular month, when the markets are within the zone of a P, that is plus minus 6% of its average 200-day moving average of a Nifty, then I will invest 20,000 in equity and 5,000 in the debt. But if the markets are trading below the average, that is, it is below the P average by more than 6%, then put in 35,000 into the equities for that month. So, and if it is above the P, then put in 15,000 rupees into the equity and put in 10,000 into debt. Then what are the returns? Now we did this calculation right here on the Google Sheet, and if you download this, you will be able to get it. And we tried figuring it out. Yes, in terms of the results, they were not as interesting as this whole compute process is, that I'll play extra smart and I'll be able to make more money. The simple thing that it kind of concludes is that if you're doing a normal SIP, you will be able to make 12.97%. And if you are doing a weighted SIP like the way I described it, which is in terms of the weights are not changing by as much as I said, then it is 13.28. But exactly the way I told, if you're doing it that way, then it is 15.64 versus 13.49. So timing the market does give you a little bit of an extra edge, but it is very difficult to time the market and then do that. So the basic objective should be that, don't try to time the market or make too many variations. What should be organized for is excellence, because independent of what you end up doing in terms of, getting the extra money, the operational difficulty of operationalizing it and looking at the returns every month in all probability will result in a indiscipline, and that is where most of the investors fail. Now, not only this, what we did was, we gave this data to AI, because I just asked Gemini to start analyzing this Google Sheets, and then I did some extra, you know, computes also, which I'll share, that what is the compute from 2015 when I leveraged Gemini really extensively, what does it tell us? And I'll show you all the steps. And one is that it'll help you analyze your data well, and the other is obviously it gives you the exposure to leverage the Gemini as a tool. And not only what we are talking, you can also leverage it beyond this on how to take the macroeconomic data sets and leverage them to your advantage. Now, the first and foremost, what we tried doing, what Gemini tried doing was very simple, that it tried figuring out whether the two things, that is the GDP and the Nifty, does it have a very strong correlation, or does it have a, uh, you know, somewhere some kind of a correlation? And then it also gave a very clear graph on how the PE has been. Let me just expand this so that we can see it well. And now we can see that the Nifty, the worst of the Nifty was obviously somewhere in the 2008 period. So the worst was in the 2008 period when the markets had the Lehman Brothers. And this is just telling you that, okay, yes, there is a drawdown during the period when the GDP goes down, and the overall how the price chart has been. And clearly you can see the two biggest values are in the 2008 and the 2020 prices. Now, it gave a very good analysis that, in terms of what we are seeing based upon the calculations done, that the compounded annual growth rate was 12.16%, and it gave a fairly good correlation in between the market and the economy, that we, when normalized to base of 100 in 2001, Nifty 50 growth has generally outpaced nominal GDP growth. Because what is happening, if you look at it over the last 25-26 years, Indian economy has generally performed better. And when the economy is performing well, it is not that the economy and markets move along with the economy. There is more growth, then obviously the markets are expected to deliver better returns. So that is what we are observing. And given the current situation of the globe, Indian markets are expected to perform better than many other markets. So you can always expect slightly better than market returns. Of course, if you are trying to put it against the dollar, then you have to figure out on how much is the delta also, or whatever currency you choose to do it. But yes, that's the key point that is coming out. And it also concluded that based upon whatever calculations are available, the weighted SIP advantage is there, but it is not that significant that we can conclude over here. And so this was a overall chart that it gave. Now then what I started doing was I started asking very, very specific questions, that can you tell me the maximum period of the downfall for 6 months, 1 year, 2 year windows? Means when did Nifty give worst returns? So it did all the analysis and kind of gave me this data that when it was 20th May 2008, after that it came down by almost 49%. So if you had just invested a few days before the crash, then you would have lost 50% of your investment. And similarly, in a period, it might have been 56%, and in a 2 year window, your amount could have been down by 37%. And I'll show you what the data tells, especially from 2015 onwards. It's very interesting, I must say. And then I also asked that, okay, when was the best time? So the best times, it gave me a very good analysis that, from obviously it went down, and then when it started catching up, that is the best time. So from 9th March 2009, when the markets finally started uptrending, it had given almost 88% return in just 120 days. So what is very important is that the markets crash and the markets go up also like a rocket. And what is very important is that you stagger your investments in such a way that yes, you might lose out on some of the profits, but you should not end up losing so much that you lose the confidence of playing in the market. And that is where most of the retail investors miss out, because what happens is that when the markets are going up, they will become greedy, they will overinvest, and then all of a sudden crash happens. And when that crash lasts for very long, people exit, they panic, and more people panic, it further brings it down. And that is how most of the crashes happen. So this is very interesting that yes, in the period of 2009, there was a period in which you could have gotten almost 88% returns for a period of 250 days. If you're looking at a 1 year kind of a period, then the best period was 25th April 2000. This is again a little bit after the dot-com crash. And then again 28th October 2005 to just before the crash period started. That is the best time. So very interesting data points. Now, of course, this is very dated because we're looking at period from 2000 to 2026, and in between the first decade, one was of course the dot-com bubble burst, and then the burst that was around the Lehman Brothers. But after that, now it has been after the COVID period when the markets were really volatile. So then I did this analysis from the COVID period, that what were the best and the worst return, and it kind of gave me very similar data for the different periods, that if you would have invested somewhere in the January or February of 2020, then you would have lost around 39% in next couple of months, because somewhere around March 23 it went all the way down. But again, after that, if you would have taken it in the trough, that is 7th, which a lot of people and a lot of family offices did, you would have been able to gain 245%. So if you could have invested during the trough, but which is very difficult, and it's not possible for a retail investor to really figure out whether 7,600 is a trough or 9,000. And when the markets are going down, so let's say you started investing at 10,000, and you invested 1 lakh when it was 10,000. When the market actually went down from, let's say, 12,360 to 10,000, you felt that 10,000 is a great value, let me invest over here. And then the markets further went down. So there also you need to figure out when does the market start upswinging, and it is better to catch the uptrend, and when a little bit of clarity has emerged. Now, even in this situation, when we are standing around the war times, uh, I don't think so that the curve really, like, it went all the way down to 22,700 or something. Now it has started upswinging from here, and it has come almost to 24,000. So, you know, it is not necessary that 22,000 was 700 was really the value. It can be that it could have gone further down, or it might still go further down. So it is important that you pick up the zones, and then you are able to invest you in those zones when the market gives you the opportunity. That is the key part of it. I'll show you that with the data, how this is helping. Now, it gave me a very similar this thing, that okay, maximum drawdown was during this period, and the maximum run up was, if you would have invested in 2020, then you would have been sitting on to 245% gain on 2nd of January 2026. Now this is very interesting, and then it gave me all the data, when what was the P, and I brought in that. But after that, what I did was, I did some analysis to further figure out that, like, one is that, of course, I just tried reverse engineering some of the details. What I tried doing was that, trying to figure out that if we take a SIP of 35,000 from January 2015, then what would have been the returns on that SIP? And that gave me very interesting, because I further qualified the data with other ask, that okay, now tell me how much cumulative numbers it would have generated. Mark the cells which I have months in which the drawdown was more than 10%, or the increase was more than 10%. Now, what is very interesting is that if somebody was investing from 2015 of January, and you would have invested all the way during the COVID days also, now it would have given different opportunities, like when you started investing, let's say you started investing in January of 2015. For a good period of time, you would have seen your returns in negative. So these are the returns, and this is, I am looking at almost after a year. So you have invested 35,000 for 9 months, and you're still seeing that there is a negative return. And then there is again a negative return in the next month, and both these are periods in which the markets have fallen significantly. And although the return, so over here it has fallen significantly, then it started going up a little bit, but still after 9, 10, or for that matter 12 months, the returns have been negative. So what is important is, whenever you are starting to invest, or you have been an investor, you will see your portfolio change very significantly during the up times and down times. What is very, very important is that you should be able to tide through it, and these numbers will tell you that. Now let's see that we continue to go, and over here it is still negative. You have lost 41,000 rupees when you've been very, very patient, investing 35,000 every month. So this is the test for an investor, that if you are investing now for good 12 months, 18 months, you have invested, and you're doing SIP, and you're not doing lump sum, because lump sum can be even more crazy. Now somewhere in between you start making money, and that trend continues up till 2020. you start seeing good returns on your portfolio, and some of the months are also excellent in terms of the change that you see. You can get very good returns. So like this month again, it was very bad. So some months are very good, 6%, 3% month on month, you're getting very good. Then COVID happens. And this is when if you think from an investor perspective, you have been investing very regularly, and now all of a sudden you see your portfolio shrink, and you not only see it shrink, whatever you had invested, now you are sitting on a loss of 1,65,000. You've been investing for 5 years, you've been staggering your investments, and now all of a sudden, it's not just that you have lost all your profits. You have lost a profit of 4,09,000, but you have also lost what your capital was. And that is where you have to be very, very patient. These situations are very far and wide because, as we talked about earlier, COVID resulted in 38, 39% of a drawdown. So this is that situation, and then it started picking up. But if we really look at it, it still took some time. So you were sitting at a profit of 4 lakh, which is an cumulative amount of 26 lakhs. And then all of a sudden it came down to 20 lakhs. And for it to go back to 26, it took 3 to 4 months. And the COVID valley and the peak was very quick, but these times can last slightly longer, and of course sometimes the numbers will come down slowly and then they will go up also slowly. And what is very interesting is that if somebody would have held on to the portfolio at that point in time, now this is dangerous. Like you're seeing this, and at this point in time you exit, because now all of a sudden all your investments and net return from the market has been negative over a period of 5 years, on that too on a SIP. So it's not easy. So whenever you get into the market, what is very important is that you understand that this money is not something that you can withdraw at your will. You can withdraw, but you will have to be patient to withdraw it at the right time. And you should be structuring yourself well enough that at any point in time you see your money go down, you should still be able to live with that particular issue. So like this, if you really look at it today, if somebody would have continued as we saw, if you would have invested during March of 2020, today it would be 245%. But even if you were doing SIP, your CAGR returns over a period of 10 years would have been significant. It is more than, significantly 15 to 16%. But where the issue could have been is that if you would have exited during a period when it was at its valley, or you would have invested more than that. Now over here, as you can see, so these calculations give a very clear perspective that as a retail investor, you should stagger your investments. If you understand the markets relatively well, then you should be able to increase your investments when the markets go down. But don't think that you will be able to figure out the bottom out. You will only be able to see the money move in at the right time, and then as the markets start moving up, you try to catch the momentum. And that is the key point that we are concluding from this particular analysis. A whole lot of interesting information. It would be available through a document which you can download, and we also offer this through a course in which there are various templates which help you identify what is the right SIP, when to invest lump sum, how do you structure your SIP in such a manner that you are able to take some advantage of the market movements. But at the same time, we recommend that you are in a position to maintain your portfolio for a long period of time and you don't exit at the wrong times. So that is the key point. I'll see you in the next one. If you have liked it, then do indicate to the YouTube algorithm. Cover some aspects of data and AI, and you can always take the course. It is available on Udemy and also through the platform, the links for which would be available. Bye for now.